In January, investors were aggressively stacking up gold, driving the price to a peak of $5,598 an ounce. It was widely treated as the ultimate financial panic button. This chart shows how fast that consensus unraveled. 6 months later, the price collapsed 27%, plunging below $4,000. It marks the single worst quarter for the asset since 2013. What makes this crash highly unusual is the timing. Global conflict traditionally drives money into safe haven assets, and right now, military engagements are escalating globally. We're seeing the US and Iran actively trading strikes again, with tanker attacks concentrated right in the Strait of Hormuz. A geopolitical conflict of this scale usually sends investors rushing to buy. Yet this exact conflict triggered a historic sell-off. The answer starts with the basic mechanics of how gold works. If you hold a gold bar, it generates absolutely zero yield. It pays you no interest and it issues no dividends. When interest rates go up, everyday cash and government bonds start paying out guaranteed returns. Suddenly, a block of metal that sits in a vault doing nothing looks a lot less appealing to investors. In May, that theoretical vulnerability became a reality with the appointment of the new Federal Reserve Chair, Kevin Warsh. Markets had priced in an expectation that Warsh would cut interest rates. Instead, he took an aggressive, hawkish stance, signaling that the Fed would tolerate zero flexibility on inflation. The mere signal that high interest rates were going to stick around drove investors to dump their zero-yielding positions en masse. But Warsh's hawkish policy didn't happen in a vacuum. It links directly back to the Strait of Hormuz. That waterway is one of the most vital arteries for global oil transit. As soon as military strikes hit near these transit routes, the threat to supply lines sent global oil prices spiking. This chart traces the resulting chain reaction. The elevated cost of oil immediately translated to higher prices across the economy, pushing U.S. inflation up to 4.2% in June, the highest level in 3 years. That 4.2% inflation reading legally and politically forced the Federal Reserve to hold their interest rates high, eliminating any possibility of a rate cut. Two massive macroeconomic forces slammed into each other. Geopolitical fear was trying to push the asset's value up, while the resulting inflation and interest rates were pushing it down. The war killed the rally because the economic side effects of the fighting fed directly into the one thing gold cannot survive: sustained high interest rates. Tracking this market means looking past global fear, analyzing the internal politics of the central bank. Right now, the Federal Reserve is paralyzed by severe internal division. Their latest committee vote resulted in a highly unusual 9-8 split. One half of the committee is demanding further rate hikes to forcefully crush inflation. The other half argues they need to hold rates steady to prevent broader economic damage. This deep institutional deadlock has completely fractured Wall Street's ability to model the market. You can see the confusion in major bank forecasts. Pessimistic models project a continued slide down to $3,300 by year-end, while optimistic predictions expect a sharp rebound up to $4,900. Buying a shiny metal to escape global chaos used to be a reliable strategy, but the economic mechanics of this latest conflict have broken that formula. The ultimate purchasing power of your savings is no longer insulated. It depends entirely on which side wins the tug-of-war between the chaos of global supply chains and the strict decisions of central bank policy.